The following program is paid for by EG Tax. All opinions or statements expressed on this program are solely those of EG Tax or its guests and do not reflect the opinions of News Radio 930 WBEN or Odyssey.
The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930, toll free at 1-800-616-9236, and cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey everybody, this is the Tax Lady, and this is our hour to talk about taxes to keep you abreast. Look, 2.5 more months and it's 2025, so we want to make sure that we get you to know taxes. And of course, I'm joined in studio with Tiffany Fabian. Hey Tiff.
Hey, happy Saturday.
Happy Saturday to you, and Christopher Fabian.
Hello, Esther.
Hello, Christopher. Okay, I heard you were like clomping on the gorge today, right?
Yes, we had a gorgeous day at the gorge.
At the gorge. It's great going down. It's not so great coming back up.
Amen.
Okay.
The dogs liked it. They
I'm
didn't
sure.
mind.
You know, it's so interesting. How can dogs go upstairs with them little teeny legs like it's nobody's business, you know?
I know. They just want to keep going. Let's go. Let's go.
That's for
faster.
Anyway, so here we are, mid-October. We have almost half a month of October, November, December. We're back into 2025. I'm going to tell you, with the election, I don't care who you're voting for, but there's going to be major changes one way or another. And of course, EG Tax will, as soon as they do whatever they're doing, we'll keep you abreast of everything. Today's topic, though, and again, we can talk about anything tax related, 803-0930, 803-0930, star 930 on a cell phone. You can text us at 716-803-0930. Last week was extension deadline, and if you haven't filed, we still will do your return, right?
Yep. Somebody came in to see me last week, and it was after the extension deadline. It was on the 16th, and she couldn't find all of her items, so we got her transcripts for her and her husband. They put them in my secure mailbox, and so we're ready and able to help you.
Don't wait till 2025 to do your 2023 tax return, because if you owe money, they're going to penalize you from the due date of the return, which was April the 15th. So unless you had 90% of your liability paid in. So it's very important. And EG Tax is there at our corporate office, 1890 Colvin. Monday through Friday, we'll make special appointments for you. So if you haven't done it, we can still do it, right?
Yep, absolutely.
All right. And then, of course, if you haven't registered for the Ready, Set, Retire seminar through the financial guys, that's going to be November the 9th. And so that's coming up, too.
It is. Yep,
Right.
It is. And we're also going to have a segment in there where we're talking about budgeting and, making plans for your future and
Right.
the economy
and there
and all that
is
good
a
stuff.
number of tax-free ways to get income as opposed to stealing the money. I use it, tongue-in-cheek, from your pension plan. Because when you take it out of your pension plan, it's going to cost you money.
That's right.
That's
Yep.
right. Yep.
So 803-0930, 803-0930, star 930 on a cell phone. Text us at 716-803-0930. All right, so I wanted to talk about, we don't spend a lot of time on it, about business income, business deductions. And a lot of times people don't think they are in business, but they actually are. Like maybe they're doing yard work, or maybe they're a housekeeper, or doing daycare for kids, or doing ticket resales, right?
Yep.
Or maybe they're a mechanic, or they do snow removal, or they're a painter, and they think, well, I haven't registered with New York State, so really, I don't have to declare that income.
Yes, you do.
Yes, you do, right? Mm-hmm. Because, and when you say, and pay me cash, I mean, if you get audited, and they did kind of like hire 85,000 new IRS agents, if you get audited, that extra income, when you spend that income, the IRS can just basically reconstruct the income that you got and come up with the additional income. So there is no really, if you're doing cash, then you're fraudulent.
Yeah, absolutely. So when we go to certain places and they're like, I know what I was thinking about on vacation, and they ask us, you have to pay in cash, and so you just wonder if they're doing it the right way.
Well, my nail lady, my nails are, right? And then they give me the bill, and then they go, and I will really like you to pay me in cash. And I say, I got to claim the income. You got to claim the income. Would you like no tip? Or would you like me to put it on my charge card? Okay, put it on a charge card, and that's the truth. People that are, especially daycare providers really get away with murder, don't you think?
Right. Well, they can. Yes, the private
Well,
daycare.
I mean,
the private.
So many times, do people want to claim their daycare provider when they
right,
want to do
right.
the child care credit? No, because my daycare provider is paid in cash.
Right. The private daycare providers
Right.
are exactly. Yep. And that, and half the problem thing is too, it's grandma and grandpa, or and they don't realize they can write off all the expenses.
Absolutely.
And
Absolutely. And a lot of people that are self-employed, that don't think they're self-employed, they don't realize it's not just the income that comes in, it's the income that comes in less the expenses you paid to produce the income.
That's right. So the amount that you have to declare is not going to be very much, and so it's a shameful thing that you're doing to the people who pay for the child care because they don't get the credit, and so that's shame on you. I feel like on the
of course.
provider.
And the other thing is, and you, Chris, you were alluding to grandma and grandpa. Explain the situation. Let's say grandma and grandpa are getting $100 a week, $5,200 in a year. Give a scenario. What would be a typical Schedule C for grandma and grandpa?
Sure. Well, if grandma and grandpa watches them in their house, then they get to write off a portion of the gas, the electric, the water, anything they do to their house. But then they also
insurance.
get to write off the toys they buy for the children, the food they buy for the children, the mileage they buy for their the grandchildren, the movies, going to the zoo, doing whatever. They get to use that as write-off. So they could bring that 52.
And part of their home, right?
Right.
Office and home. So when you take all those expenses, like you even mentioned picking up the kids, that's all deductible. When you enumerate all those expenses, you find out that grandma and grandpa really don't make a net profit at all.
Yeah.
But mom and dad, though, would save over $1,000 in taxes by claiming the child care credit.
Right. On the federal and the state, and they'd be doing. They'd be surprised if they actually, and that's why we come in with your parents. Let me show them what can happen and what you can save, and
Right.
But
And the other thing is that, and this 1099-K form is going to become more and more prevalent as we start moving forward. And so, what form would that be, and how is that handled?
well, that's if, say, you pay your daycare provider through Venmo. So every week you send her a Venmo for the money. Well, any yearly total over $5,000 this year will get a 1099-K, and that babysitter now has to claim it where they think they didn't have to before. So
Right, absolutely. And so when you get that 1099-K form, you have the IRS is going to get a copy of it as well, and so then you want to reduce the income by any expenses to produce the income. And this goes if you're selling Bills tickets, right?
Yep.
Or Taylor Swift concert tickets.
yeah, that's
Right,
still
which
going
I've been
on.
accused of having it on my website, which I don't have. But I mean, all of those things reduce the 1099-K form you get, or a 1099 MIFC, or whatever the 1099 form you get. You want to make sure you put that on your tax return, because they're looking for it as income, but then you can reduce it by the expenses. The other thing is an LLC. if you have an LLC, what else do people have to watch out for?
The
You have to do, by the end of the year, you have to do your BOI. You have to do your BOI, and you have to report to the FinCEN that you're a business and who the owners are. They want all the details, or there's a fine.
$500 a day.
Up to $10,000.
Yep.
Right? And I just had a client the other day on Friday that said, I have 6 partners. Do I have to do the BOI? Oh, yes. All 6 partners have to be listed on that beneficial ownership document to the federal government. Otherwise, you're looking at a potential fine of at least, $500 a day up to $10,000. And of course, EG Tax will help you with that. Right?
Exactly.
All right, well, we're going to take a short break. I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on a cell phone. Text us at 716-8030930. We'll see you on the other side. Hey, to us, you are family. I'm Esther Golias, the tax lady. 8030930, 8030930, star 930 on a cell phone. Text us at 716-8030930. Somebody texted and said 3,500 IRS agents. The truth is it's 86,000 new IRS agents. So, that's a lot of IRS agents.
Yeah.
But here's the thing. If you're self-employed, whether it's a larger company or smaller company, you want to make sure that you use all of the expenses to produce the income. That's really important. And part of that would be you can put money into a solo 401k plan. And you know that the maximum that you can put in this year, if you're 50 or older, would be $76,500 into a pension plan. I mean, that is a great deduction.
Oh, yeah.
It's huge.
I met with somebody last week, and they're self-employed, and they made $136,000, and there's not a lot of expenses against it, and they didn't do any quarterlies or estimated payments. So they're gonna, with head of household, they're gonna end up owing about $26,000 to the federal and about $8,000 to the state, and they haven't planned, unfortunately. And so I talked about the solo, I talked about the SEP, I talked about the health insurance deduction for a self-employed person, and it's just a good option.
Well, what people don't realize is when you are self-employed, you have to pay your own Social Security and Medicare taxes. When you're an employee, your employer does half, you do half. And people don't even realize how much is coming out of their paycheck to pay for this FICA. When you're self-employed, you pay the whole 15.3% yourself. So if you made $100,000, your Social Security alone is going to be right around $15,300 plus income tax. And so somebody tax planning for this kind of a situation, let's say they need a new truck. If they bought a new truck by the end of the year, they could do a $179 expense of up to $30,000, and that would save them $46.67 in Social Security alone, plus income taxes if they're in the 30% bracket of $91.50, or they would save $13,817 by just buying a truck. And that's why planning is so important, and that's something that we do at no charge, right?
Right. We'd love to help you. Like we say, no hidden surprises at the end of the year. Come in now and let us
I mean,
work
you
it out.
still have 2.5 months.
That's right.
And especially if you're self-employed, you want to do a tax plan because the FICA can really bite you in the butt. I think about real estate people who really pay a whole bunch because they do very well. The hardcore real estate people that are really out beating the bushes, and they can pay a whole bunch in FICA and income taxes and quarterly payments. And so just by doing some simple tax planning, like for instance the 401k plan, the SEP, buying assets this time of year, can really knock the wind out of those taxes come tax time, right? Mm-hmm. So, all right, and the other thing is when somebody's self-employed, I think they always say to themselves, should I do an LLC or should I incorporate? Well, one of the things that if you do incorporate, you want to make sure that you look at doing an 1120S as opposed to an 1120C, right?
Yep.
And that would be why?
Because on a C corp, you pay double taxation, whereas in an S corp, you just pay one time and you pay yourself a fair and equitable wage, and you don't have to pay that double taxation. And so it'll avoid you paying some tax if you make that election to be an 1120S.
Right, but now here's the other thing, Chris. What's the flat rate on a C corp?
21%.
Right, and if you were in the 10% tax bracket, if you did an 1120S, you'd be paying 10% rather than 21%, plus the double taxation, right?
Right. Yep. So you really got to do proper. Is this the right thing? Is this, what's the benefits? What's the downfalls? And you got to do a lot of planning.
Right, absolutely. So, so those are, I mean,
And
and
another
obviously, if you're a do-it-yourselfer, you don't know the ins and outs, right?
Yeah.
So there are people that have C corps that are paying double taxation who absolutely should make the election to become an 1120S.
Yeah, and I also wanted to say, when you incorporate, you get that level of protection. You're a separate entity, whereas if you're a DBA, if anybody God forbid, falls or hurts themselves, they can come after your own assets. Where if you're a corporation, you have that bubble of protection, which is really a good thing. Of course, there's always the option of getting insurance too if you're a DBA.
Right, that's true. But obviously, just by changing from a Schedule C to an 1120S, it doesn't cost a bunch of money, and it affords that extra layer of protection, right? So that's something you might want to do. Okay, let's go to the phones. 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. And we have Tom. Hey, Tom, how can we help you, sir?
Hi, Esther. Nice to talk to you guys. Love your show.
Thank you.
I'm looking at getting a new furnace in the next month or so, and I'm between the high efficiency and the standard efficiency, and I wasn't sure, are there any major tax benefits with going with one or the other?
I mean, I'm assuming that you actually have, you're a working person and have a tax liability, right?
Correct.
Because it's a non-refundable credit, but yes, the credit is 30% on the highest efficiency furnace, hot water tank, air conditioning, windows, doors, high efficiency windows, doors, but the maximum is $600 for the furnace, and then the air conditioner, if you get that high efficiency, another $600. The maximum that you can have is how much per year, you guys?
$1,200.
$1,200, right? But total $3,200 if you have other forms of energy conservation. But yes, you can. Many people opt for the lower efficiency because they don't want to pay the upfront cost, but then it doesn't qualify for the credit. So you really have to see which is going to be better. Plus, in the long run, the higher efficiency furnace is going to cost less to operate.
And is that $600 off of my adjusted gross income, or is that just...
No, it's an actual credit.
It's
They're gonna
off of
send
your
you the-
tax, which is
Right.
better.
Right, it's actually
okay.
$600.
Oh, cool. Okay. I appreciate it. Thank you.
All right, thanks, Tom. And I'm going to tell you, this is October in Western New York. Guess what's coming?
I can't
Besides
say it.
Santa Claus. I mean, really, winter's coming, and so now's the time to look at those doors, windows, furnace, hot water tank, insulation, because you can get a great big tax rebate when you file a return. The other thing is you got to understand, the first thing I asked Tom is, did he have a tax liability? Why is that important?
'Cause like you said, it's a non-refundable credit. It can only be used to eat your taxes. You don't get the extra money back.
Right. So especially if somebody's out selling you a bill of goods that it qualifies for the credit and you don't have to file a tax return, it's not going to save you anything
Right.
unless you come up with a source of income. So what we say to people is, maybe it would be a good time to take money out of your 401k plan that would be or your IRA that would be taxable, so you can then use that credit to offset the liability. And for all intents and purposes, you took the money out tax free.
Right.
That's
and
right.
that's like buying an electric car. Yeah, there is a $7,500 credit out there, but if your tax liability is only $2,000, you're only going to get a $2,000 credit on the federal. So
Right.
you got to really do planning when you're thinking you're getting this big credit.
Right. And we are absolutely happy to talk to anybody at any time. You can call our corporate headquarters. You can go to our website at egtax.com, because it's so sad when you sit in front of somebody and they come in thinking they're really going to pull a fast one over the IRS. They got all new windows and new doors, and they have no liability, and you can't carry forward that credit to the next year. It's use it or lose it.
Yeah, and then the sales people selling you the doors or the windows, they're not familiar with it, and so you really got to make a phone call and make sure that you've got what they say you got, coming.
Okay, I'm Esther Gilius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. By the way, we have our one last tax class that's going to be starting. We have a kind of a really fast-paced class that'll take place the first part of January. So if you didn't get in our fall class, you can still get into our accelerated tax course that'll take place the first week of January, and you can register by contacting our corporate headquarters, and you can do that through it's on our website too, right?
It is, yes.
Right. Okay. All right. And the last thing I want to talk about before we break for the news, but I think we got to break for the news, darn it, but is I want to talk about the QBI. There are all kinds of people that don't know what the QBI is. I just did a tax return the other day, and this gentleman missed the QBI, and we want to talk about that on the other side of the break, because you want to listen, because even if you're an investor, you might have QBI on your end-of-year report from your broker you didn't know anything about. I'm Esther Goliath, the tax lady. See you on the other side. We're going to break for the news. Hey, this is Esther Goliath, the tax lady. We're talking taxes. We have 2.5 months. Oh my gosh, until January. I can't believe it, 2025. And I'm going to tell you, everybody's talking about taxes that is running for office. And so whether it's going to be liberalization of tax deductions and tax rates, or tightening up people with tax rates and tax deductions, we will keep you abreast. That's what we do. We want to make sure that the people of Western New York that listen to WBEN, they know taxes, and we want to make sure that you avail yourself of all those tax loopholes. Speaking of that, the QBI, what does that mean, and who gets it? And it sounds like a mystery.
Well, unlike the BOI, this is something that affects your tax return. This is a qualified business income deduction. So
what does that mean?
It means you can get a 20% adjustment to income of your net profit of your business, or your REITs if you're invested in a REIT.
Or real estate,
Or
really,
rental.
if it's professionally handled, right?
Right.
Because you're talking about a real estate investment trust, but you could be a realtor, a real estate investor, have rental property, maybe 2-3 units completely set aside, and your net profit is $10,000. You'd end up with a $2,000 deduction, right?
Right.
I mean, that's a big deduction. But here's the thing. People don't know about the QBI, and they don't know where to take the deduction, and what they'll say is, no, I don't itemize. Do you have to itemize to get the QBI?
No.
No. It's an adjustment, just like an IRA is an adjustment, or your HSA is an adjustment, or your education expenses, if you're a teacher, is an adjustment. The QBI is also an adjustment. Now, what if you don't have a small business? What if you don't have rental property that you're conducting as a business? What if you don't have a real estate investment trust? Where else would somebody would a QBI be listed on a tax return that somebody might have missed?
On their brokerage statement, on the 1099 combined statement form from their broker.
That's exactly right.
Yeah.
So if you're a do-it-yourselfer and you didn't know what the QBI was, and they listed it sometimes as a 199A, right?
Correct.
And it's listed as 199A, and you go, well, I don't know what that is, so I just won't put it on my tax return. Well, then you've just shot yourself in the foot, right?
That's right. That's right. Yep. I mean, there's no line on the worksheet in my program, so I'm just going to blow by that.
Right. And so if it was $4,000, you would have overpaid your taxes by $800. Well, you would have had an adjustment of $800, right?
Right. Right.
20% of that.
Yep.
And if you missed it, we can get you your money back.
That's right. We can go back and amend the return and do that for you.
Right.
Yeah.
So the qualified business income, if you're self-employed, if you have self-employment, now there are limitations, because if you have a lot of income, then you also have to have wages. It's not a simple computation.
Yeah,
right?
and then also you have to. You may have said this already. You have to look for it on the K-1. So if you have an accountant who prepares,
That's a great point,
Yeah.
Tiff. It's listed on the K-1, and if you had gotten a K-1 because you're in a limited partnership, for instance, or a partnership in general, and it's listed on there, and your accountant didn't see it or you didn't see it, you need to amend your return.
Yeah, because you're shooting yourself in the foot. And then there's even some times when the accountant prepares your corporation and they don't take advantage of the QBI, and so they miss it on the K-1, and so the corporate return would have to be amended too.
Right. Well, at least the K-1 for sure.
Yeah,
Right?
that's right.
All right, I'm Esther Goulias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. We have a big text, right?
Yeah, it says, so Esther, is it okay if I normally get a tax refund each year? Would I still get the furnace rebate? I do work. I just normally get money back from New York State and the Fed. Wasn't sure if that's what you meant, that you needed to owe money when you said have a tax liability.
Okay. And I guess, when you're talking about this, many people don't have a tax liability. They know they file a return, they know they get a refund, but the truth is, when they do all of their computation, their income, their credits, like the child tax credit is $2,000 for each child that would qualify as your dependent that's under the age of 17. And so you might have a tax liability of $5,000, but you have credits because you have 3 kids under the age of 17 of $6,000, so your tax liability is zero. Not only is it zero, they're going to pay you $1,000 because if you're working as a refund because you have excess credits. So what people don't understand is, do you really have a tax liability? And that's where we invite you to call us. We'll tell you the line to look at, and many people don't pay taxes at all. Right?
Yeah, absolutely. And that's what you mean by liability, people who have no tax liability. But this gentleman works, and probably he has a tax liability.
Well, it all depends if he might have children, right?
Yeah.
Right? Or maybe he's got a Schedule C with a big loss. I mean, you just you don't know. Or I mean, you might have a liability. Probably you do, but we want to make sure, because if you say, well, gee, I listened to Ask the Tax Lady and I should get $1,200 back, but you have no liability, you're not going to get it.
Yeah. So, for instance, if your refund is $1,500 and your withholdings on your W-2 is $1,500, that means you had no liability.
Right. Absolutely.
And so that's
There, and there's earned income credits. What I think, and you guys, Tiff, you're not teaching this year, are you?
No.
But Chris is.
Correct.
You haven't gotten to credits yet, have
No.
you? I mean, it just blows your mind to find out how much the federal government gives back to people, and they not only don't pay taxes, we as a country give them refunds if they have children that live with them. Specifically, that's one of the biggest credits, is the earned income credit. But we talked about the daycare credit. That's another credit, but that's non-refundable. Then there's the additional child tax credit. That's if you can't use all the $2,000 to reduce your liability, they're gonna send you money back if you work. I mean, there's just all kinds of credits that you get as part of your tax liability, tax computation, and many people don't end up with a tax liability at all.
Right. It's
Okay. Now that's it. We have no other text, right?
No.
All right. 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. Hopefully I answered that question for the person. Okay, so what do you do? I mean, right now, here we are, 2.5 months before the end of the year, and I know there's people that still haven't gotten refunds. What should they do?
They
From
should,
last year.
They should go on to irs.gov and check the status of their refund because there's a lot of details on that. It's really simple to do. Also, calling the IRS because probably there were a letter that was mailed to them 99% of the time where they had to prove their identity.
So what does that mean, and how do they know it wasn't a scam?
Well, if they haven't gotten their refund yet,
That's like a hint,
that's
right?
a big hint. Yep. So
Actually, I had a client of mine that we did an amended return for, and he kept checking with the IRS, and they said that they mailed it out. It didn't get into his. He didn't get the check. It was stolen out of his mailbox. And the only way he knew that was we actually had to call the IRS with him. And they said, no, we mailed it out on such and such date. And so it was stolen. So you have to go through that whole thing about replacing a check. But the thing is, if you're somebody that hasn't been getting your refunds, you've been filing, haven't gotten your refund, maybe you did it yourself electronically and it rejected. What does that mean, rejected?
that means the IRS didn't accept the return because maybe you used a wrong social security number. You had
Employer
health
ID
insurance.
number, right?
What was that?
Employer ID number might have been wrong.
Yep.
So if it's rejected, you know you sent it, they know you sent it, but as far as they're concerned, it never really processed. And so it's like you didn't do your return. So that's one way that you didn't get a refund, right? Another way is, like they were talking about, Tiff and Chris were talking about your identity. The identity theft letter will hold up. It's like the wheels of the bus falling off. You have to answer that letter. And if you have gotten a letter and you've just been sitting there thinking about what should I do with this letter, you can come in and we'll help you with it. We can't interface with the IRS for you because you're the person they want to make sure is real. I had a client the other day that said, well, I've been filing for 35 years. I don't understand why they're asking now. Because somebody obviously did a tax return using their information, and they want that information before they issue the refund.
Right. And, one thing we always say is, why do you let the IRS hold on to your money, right? You don't get a refund. You should owe them money. And this is one of the reasons why. I have not seen an identity letter yet for somebody who had a balance due.
No.
You
So
haven't?
you scratch your head.
No. It's all
No,
refunds.
I wonder why that is.
Right. Right. So get your money throughout the year, and you may never have to worry about an identity letter with the IRS.
Here's the other mystery. People don't want to owe money, right? They don't. So they'd rather have the IRS owe them money. Does the IRS pay them interest on that money?
No.
No. And then the IRS can say, jump through these 12 hoops and we'll give you your money back, right?
Yeah.
But if you don't jump through the hoops, we keep your money. So how can people get the money up front, especially now we have Christmas a couple months away, and people are going to be wishing they had some more money. They can do that by effectively changing their W-4, right?
Yep. A lot of employers have you do it all electronically nowadays, or you can print a W-4 and walk it in and hand it into Human Resources, or maybe both options would work it with your employer.
So if you're somebody that's gotten a $5,000-$6,000 refund in the past, you can actually change your W-4 at work or if you're on a pension, or you might be collecting Social Security, and your Social Security is not taxable and you're having them withhold. Any place where they're getting money from your money that you're sending in the form of withholding, you can affect a change of that right now. Get more money as you earn it, as they pay you. Less, your refund is going to be less, but then at the end of the year, they're not holding up your refund.
Absolutely. Which is, like Chris says, you're sort of in the driver's seat.
Right. So changing your W-4 at work, your W-4P, if it's a pension, you can contact New York. You can contact Social Security if they're doing withholding on your Social Security, and that way it gives you more money to live on.
Yep,
Right.
and we're coming up to the holidays.
Right. All right, we're going to take a short break. I'm Esther Gillies, the tax lady, 8030930, 8030930, star 930 on a cell phone. Text us at 716-8030930. We'll be back on the other side.
The bills make me wanna kick your heels up and throw your hands up and throw your head back.
Well, I guess it's another day tomorrow, right, guys?
Yep.
That's right. So
And
we
I-
know where
and
you'll
I-
be.
and
You'll
I-
be in the closet hiding.
I will be in the closet. I just can't. I love the Bills. I love the Bills so much that it makes me physically upset to listen to the game.
Well, you would have had
I'm absolutely a crazy.
you
person.
would have had a tough time last week because the penalties on both sides were just
Yeah, I love the Bills.
very
Anyway, I also love taxes. I love taxes.
you do.
I mean, I don't love paying them, but I love helping people so that they don't pay any more than they should. And I get the biggest kick out of it when we save people money. That's what we're all about.
Yeah.
All right. So wanted to talk again. 8030930, 8030930, star 930 on a cell phone. 716-8030930 is our text line. Things coming up here. We have a couple months. You got to make sure you do your RMD. We got all these abbreviations: BOI, QCD, RMD, and we can do a QCD for the RMD. What does that mean?
A qualified charitable distribution.
Right.
So you can take money directly from your IRA, and as long as you're over 70 and a half, you can have it go directly to a charity so it doesn't touch your hands. And this way, it counts towards your RMD.
Required minimum distribution.
Yep. And so you put it on the tax return, and then it comes off right on page one. It's not an itemized deduction, so it saves you immediate money.
Right. And that can save you health insurance, right?
Mm-hmm.
I mean, Medicare,
It'll
right?
Yep.
keep your Medicare costs down.
Taxability
And
of your
it
Social Security.
Right, it's taxability of Social Security. Saves you money both in the federal and the state. It's up to $100,000 that can be taken out of your IRA, can only be in an IRA.
Right.
So now if you have your money in a 401k plan, you can roll it over to an IRA and then do the QCD. But it's a way that you can take money out if you're a charitable person and you're going to give to charity anyway. Let's say you give $3,000 a year to your church, and your RMD is $3,000. You can do a direct rollover from your IRA to that charity. Then it's not taxable at all, and it's a great way to do your RMD, right?
It sure
And
is.
you have to do your required minimum distribution if you're over the age of, if you're 73 or older, correct?
Correct.
And if you don't do it by 12/31, there's a penalty. So you want to make sure that you get your required minimum distribution done. And the other thing is, I mean, I'm sure you guys have seen it, where somebody will call their broker the last week between Christmas and New Year's, and then it doesn't get done, right, in time.
Yeah, which is very hard.
So now's the time. You got the time. Contact your broker or your bank if you're if you're 73 or older, and tell them you want to do your required minimum distribution. And if you're of the disposition that you'd like to give money to your charity, do a qualified charitable deduction, a rollover. It goes directly from your financial institution directly to the charity, and it saves you money.
That's right. That's right. I know I have somebody coming in this week to do that, to amend their return, because they did do that and they never told the preparer, and it might be only 2,000 or 3,000 that they did, but that's going to get them probably about $500 back a year, because it's going to be less Social Security they're
Right.
paying tax on as well. So,
Well, I would pay the $45 or $50 to have the return amended to get a couple of hundred. Yeah.
yep.
Right, absolutely. All right, and then the other thing I wanted to talk about, Tiffany, you're the offers and compromise lady. What does it mean to do an offer and compromise? Who qualifies, and what do they have to do?
Sure. So that's somebody who owes a whole lot of money to the IRS or New York State or both agencies. And so it's down to collectability. And so that's those commercials you hear where you're doing the Fresh Start initiative or pennies on the dollar. So perhaps maybe you owe $40,000, $50,000 and we offer pennies on the dollars to the IRS. Now, I can't stress enough, it's down to collectability. And lately, I hate to say this, but they've been sort of tough. If you're somebody who owns a house or makes a decent amount of money, you don't have a doubt to collectability. The IRS will let you pay over 70 or 80 months. And so you really have to be in a situation where you are hard up and you don't own a house and you don't have a lot of assets. And so if you are in that situation, we would love to help and do an offer and compromise.
Well, let's give some concrete examples so people that are, I want people to understand what you're talking about. Doubt as to collectability, it means that as far as the IRS is concerned, you're probably never going to come up with the cash to pay this, right?
Yep.
Right.
That's what doubt to collectability.
You're on disability now instead
Right.
of working.
Right.
You know,
The large medical bills, you can't go back to work.
Right.
Maybe you're waiting for Social Security to kick in and that'll be your only source of income, right?
Yep.
Yep.
Yep. That's exactly
And
right.
you don't have a big pension
Asset.
plan. You don't have a bunch of equity in your home.
Right. Right.
Right?
You got it right.
So that would be doubt to collectability. And if that's the case, basically you submit a form 656, right? To the IRS, and you say, here's John Smith. He owes you $30,000 and you're never going to get blood out of this turnip, right?
That's right. That's right.
And so basically you offer them the most that this person can come up with, right? And sometimes it saves them $30,000, $40,000, $100,000 in taxes.
Yeah. For instance, I just did an offer and compromise not too long ago for a lady a couple years older than me, and she unfortunately just lost her husband. She lost her mom. She lost her dad. She lost her uncle. Oh my gosh, I was in my office crying and crying. And she's a bus aide, and she doesn't make much money. She doesn't own a house. And so we did the offer, and it looks like it's going to stick. So there's a concrete example for you.
Okay, because she has no income and like
She has
nobody to
some
help
income,
her up,
but
right?
not much, right?
Okay. All right. And so obviously if you have that situation, now, if you owe a bunch of money and you're just a repeat balance doer, if there's such a word, then they're not gonna play cards with you, right?
Correct.
You got to be clean for 5 years, right?
Yep, that's right.
Or else the liability comes
It'll
back.
be defaulted. Yep,
Right.
That's right.
So if you think, oh, gee, this sounds like a great thing, I'm just going to really shaft it to them, it doesn't work like these people are not dumb.
No, no.
And they you
They're
got you can't pull the wool over their eye.
The biggest debt collector in that we know of
Is the IRS.
is the IRS.
Right. And you don't want them to be mad at you.
No.
All right. So then the last thing I want to talk about is gifting. Again, we're looking at the holiday season, and maybe you're somebody that wants to do gifts to your family. You can give up to $18,000 per person per year, right, without having to file a gift tax return.
Right.
Right. Not pay taxes, file a gift tax return.
Right,
That's where
because-
people get confused.
That's right. So filing a gift tax return, you have this big exclusion, like $13.5 million before you actually owe you'd actually owe estate or gift taxes. So $18,000 before you have to do the gift tax return, and if you have an estate that large, then you want to make sure that you do some planning because you're going to owe estate taxes. But we got a quick call here that we can do, right, Tiff?
Oh, nope, it was just a question, and they hung up, and the question
All right.
was
So,
answered.
and the other thing is, if you're inclined to want to give your house away to your kids, it's really better that you would put it in a life estate as opposed to gifting it to them, and that would be why.
The cost basis, because plus then they could kick you out of the house if you just gift it to them. Because, you give them, if you give them the house, they control the house. But more importantly, for tax purposes, your cost basis becomes their cost basis.
Right, and if they go to sell it, they'll end up paying taxes. Not to mention how if the house becomes theirs, then it isn't yours, and all those credits that you might have gotten, school tax credits, they go by the board, right?
Correct.
So if you do a life estate, though. Your children cannot have you leave the house. They get a stepped up basis upon your death. All of the tax benefits for school taxes and the STAR program stay in effect, and you control everything. So that's a much better thing to do. So again, in this holiday time, as we're approaching the holiday season, Christmas and New Year's and everything, you might want to be generous. The gifting is $18,000. Life estates for your house, your house, and you can give more than that $18,000. Husband and wife could give $36,000, and actually, there's other ways you can give more money for education and for medical expenses as well if you give over that 18. So the important thing is there's a 5-year look back if you're looking at going into a nursing home and you think that you want to go on Medicaid. And so these are all things we keep talking about, tax planning and tax planning and tax planning. All of those things that are in the law that you don't know about, if you do it incorrectly, you can't undo it many times, right?
Right.
And that's what's so sad.
Yeah. You got to
that's
get
what's
the answers before you do it, not after.
Right. All right, I'm Esther Golias, the tax lady from EG Tax, with Christopher Fabian, Tiffany Fabian. We're at 1890 Colvin in Tonawanda. That's our corporate headquarters. We're there 9 to 5 Monday through Friday. Once it's tax time, we're there 9 to 9, actually 9 till 2 o'clock in the morning, really. We want to help you. Our website is egtax.com. You can go there, ask the tax lady, ask a question. Happy to help you. If a tax question pops in your head, give us a call. We're happy to help you. We have actual people that answer the phone, so you're not going to be relegated to some answering machine someplace. But until next week, go Bills. I'm Esther Golias, the tax lady. Thanks for listening. Have a great day.
The previous program was paid for by EG Tax.